Hello everybody, Randy Patrick here once again, Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns. A lot to talk about today, but I'm going to be more commentary than actually reporting on the news. It's interesting to see how information ebbs and flows based on previous articles and what goes on in the previous week in the housing market. So today we're going to have a lot of talk about renting and affordability and seeing how everyone's affected as a trickle down or domino effect of what's going on in the marketplace right now. So today is Tuesday, July the 2nd. Hope you're doing well. It's a holiday week, so some of you may be traveling, maybe taking some time off, spending time with family or friends. So I hope you have a great week and enjoy it, and we'll get into it right now. So typically, I see trends in news articles, and this week it's sort of been about affordability and renting. And ultimately, it's funny because depending on who writes it and where it's coming from, the information can have two completely different opinions or perspectives on what's going on. So that's part of, I guess, journalism and writing and how we interpret things. So this article is in Housing Wire. So more renters than ever before saying renting is cheaper than buying, but are they right? So Freddie Mac did a survey, reveals more than a third believe home ownership is less accessible now. So according to a recent survey by Freddie Mac, 82% of renters now view renting as more affordable than home ownership, and that's up 15 points from last year, and it's at an all-time high for this survey, which is kind of interesting because, again, we've come off of, last year, which was all-time high home prices, and even some of the Case-Shiller numbers have crept up already this year. So people, I believe, at least this segment of the population believes that homes are far too expensive. So, but the data also shows that renters actually spend more of their income on housing than buyers do, with 35% of renters spending 1/3 of their income on rent, while only 25% of homeowners spend that much on their mortgage on average here. So that's a great study, but we realize that when you take a look at this, that housing prices are expensive. We know that rates haven't made a big, dent in the marketplace for new buyers, but we also know that, the government, like Fannie Mae, FHA, and even Freddie Mac, they're encouraging, 3% or low down payment loans. They're also encouraging high debt to income ratio buyers. So when they look at this and say, well, only 25% of homeowners spend, 35% or more on that mortgage, that's going up. Okay, I can tell you that as we know, with respect to the incentives to get people to overbuy or get them into higher price points because they can't find homes where they're looking right now, that we know that DTI is going to increase. So I don't think that's really a good argument here. I think that that's going to change over the next couple of years. And again, renters cited the upfront cost of owning a home, including down payments and closing costs, as the biggest barrier to making the leap to homeownership. Also, 40% of renters said they thought a monthly mortgage payment would cost more than a rent payment. So you never know this time of day. So, which brings us to another article on the Wall Street Journal that says fewer renters believe they are likely to own a home, which is pretty much, I guess, the derivative of the same article here. So the funny thing is we see this in different locations. So only 24% of renters said it was extremely likely that they would ever own a home, 11 percentage points lower than 4 years ago, according to the survey, which is released by the mortgage finance giant Freddie Mac. So again, it just shows how, we have different spins on articles here and with the same information. So it's all about perspectives, all about who writes it, I guess. And obviously the biggest obstacle preventing renters from buying a home is what? Saving for down payments and closing costs. The crunch is being felt by about 80% of millennials and members of Generation X, people who were born between 65 and 1980, and 71% of baby boomers who rent. So student loan debt is making it especially hard for millennials to afford down payments. And again, as we keep going through this, it's taking longer and longer for people to save the required, the sort of customary 20% number. I know there's a bunch of articles out there that show that, hey, depending on where you live in the country, it could take you 30, 40 years to save that 20% down payment, which typically means homeownership is not going to be a possibility for a certain segment of people in the population. that's where, of course, Freddie Mac, Fannie Mae, and FHA step in and say, hey, we'll offer you, loans with lower down payment, higher DTI to get you in that property, causing more problems. There you go. And again, another article. This was off Zero Hedge, but basically it said the National Low Income Housing Coalition has published the latest out of reach report that shows that renting is becoming increasingly unaffordable for countless Americans, and ultimately it boils down to that it takes a look at like average wages versus average prices, median wages, median prices. It just goes to show that an average renter in the U.S. has to work 52 hours a week in order to support the average housing wage that they need to get into the average price for a 1 or 2 bedroom home, rental place. So basically, that's obviously a struggle doing more than 40 hours a week, 52 hours a week, especially for, they say, single parents or someone struggling with disabilities or some hardships and setbacks. So again, same basis of article, just different perspective. But ultimately, and I think what we all know is that renters are taking a hit now. So obviously, home ownership, is less and less appealing for a large part of the population now. People don't want to buy. People are going to wait to buy. So they're forced to rent. And now we see rental rates are increasing. And we know that there's competition amongst rental occupants now for single family homes. A lot more multifamilies being built. So there's there's a shifting in housing needs. There's also a shifting in housing perspective going on as we speak here, which brings us to something. This is an older article, but I thought it was pertinent because when you have a surge in rent and you have a lot of issues with the economy, you have what's called an eviction crisis. So basically, there's some old article here from March saying eviction crisis starting to look a lot like the subprime mortgage crisis. Why? Because certain demographics and certain market segments tend to be to fall more into this category and have more issues with their landlords based on income and location and things like that. So it's part of the game with respect to renting. Obviously, landlords need to get paid, and sometimes people have a hard time paying rent on time, etc. So it just shows that there's all these sub-market issues going on in housing. We talk about affordability, buying and selling homes, then we shift down to the rental market, looking at the single-family residence as an asset class. Then we look at the people who are trying to rent or can they afford to rent, and now we look at the situation of eviction. And we know with respect to the homelessness population that homelessness is rising. A lot of the major locations across the U.S. have huge, people send me videos and links and stuff, and I'm literally astounded at the amount of people living in these little tent cities and the issues they have to deal with. It's just out of control. So not enough, not enough thought process is being given to low-income housing, affordable housing, and things like that. That's a great opportunity, but it's not being looked at by the general population. It's not being looked at by governments. It's not being looked at by investors as well, too, because obviously if you're going to build something, buy something, rent something, you want it in an area where it's better for you financially. You want to have a certain dollar value for market rent, and that's what people prefer. So this is a true segment of the population that's not being serviced that has the biggest need, which is very unfortunate. So Harvard put out a study. Harvard University. There's a housing shortage and it's eroding affordability. Now, I typically like Harvard studies. There's something called the Joint Center for Housing Studies, which comes out of Harvard University, and they typically do pretty good analysis on housing market, affordability, rentals, the whole bit. I think this is a bit late though, because it's talking about in late 2018, the housing market lost steam as interest rates rose and new construction, home sales, and home price appreciation slowed. Even as rates came back down early in 2019, things did not let up. So we basically are seeing ourselves, we're seeing some market increases with respect to inventory. We're not saying it, we're seeing maybe 10%, 12%. Granted, some locations have had some good spikes. Southern California's locations had a lot of spike in inventory, but inventory that comes on, we're not seeing price decreasing at the same time. I guess you could say at the right proportion amount to get in, so buyers can get into homes a little quicker, a little easier, a little better. So that's that's kind of our situation right now. So people still want to gain on their homes. People are still trying to hold out for higher dollar values. Every month we look at sales, we do see Case-Shiller dropping, we see NAR dropping, we see Redfin dropping, we see a lot of statistics and indexes dropping, like price is eroding, appreciation is eroding. It's not eroding fast enough, and where we are today is that we're still sort of crawling along. Every month it's slower and slower. it's negative appreciation. It's getting less and less. Eventually, some locations, we're going to start going below the line now. We're going to start to lose value, which should happen the next month or two. But again, Harvard basically said, it's the housing shortage, and locations will still rebound or could still increase in value if we don't see a lot of inventory coming on, and that's kind of the issue. We don't see inventory coming on. So again, trying to get into a house these days, whether you're a buyer having difficulties with down payment and affordability, or whether you're a renter, it's affecting a lot of the population. So it's kind of like we've got nowhere to turn right now. So hard to buy, hard to rent. Something's got to give at some point in time in the future. So having said that, with respect to buying, I saw a video today on CNBC. It's regarding a company called Unison, and what they do is what's called down payment co-investing, and that really is it's not down payment assistance, because it's not like you're getting a grant or maybe a forgivable loan or something you can pay back over a period of time or get with low interest or no interest. Excuse me. This is down payment co-investing. It's gaining popularity. So there's a home called Unison. They've been in business for about 3 years. So far, they've lent $3.25 billion in over 30 states. So they're a startup, but they're not like it's just happened last month. They've been working for 3 years now. So they're looking to seek long-term partnerships with a prospective home buyer. And what they're going to do is they will help you. So if we need that 20% down for the mortgage, they're willing to enter the game with you. And just so people know correctly, I mean, yes, you can go to an FHA and you can go to Fannie, Freddie, whatever you want to do, and get low down payment mortgages, but anything below 20% has PMI, which is private mortgage insurance, which is tacked on to the cost of the loan, which raises your monthly payment. So what you're doing, if you have a co-investor or a co-down payment partner, if you can bring 5%, they can bring 15%, then you've got your 20% down. Your mortgage payments are going to be cheaper, and you've just created, you've reduced a bit of risk element and helped your payment value as well too. So again, they're looking for long-term partnerships with prospective home buyers. They look at it as a win or lose situation. So if the whole point is that you're going to buy your house, you're going to stay in your house for roughly 8 to 10 years. That's the average home ownership. And when you sell the house, you're going to share, I guess you could say, the uptick, the equity, the profitability of your sale with this group called Unison. So I listened to a video with respect to the CEO, and he said as much as he could. I'm sure there's more fine point in discussion, but I just want to get back to the concept going, more and more people are going to look at these type of arrangements to get them into homes, which really, it's good, I suppose, it's innovation, but in the end, it's still circumventing the problem at hand, which is affordability. So if I only have 5% down, but I'm gonna roll the dice, with 80% loan, and I've got a 15%, excuse me, I guess you say grantor or gift coming my way. That's going to help me, but I'm still on the hook for it. So again, it's agreed to percentage up front. So I guess this company and the home buyers go into some sort of arrangement where they figure out, what the down payment co-down payment investing is going to be. They figure out what their percentage is going to be and what the return is going to be with respect to paying that company back. So their perspective is, if you sell, then we're going to get our 15% back plus an uptick. There's also, I guess, a position where, hey, guess what? Maybe you get a better job, or financially something happens and life is good and you've got more money rolling in. Will they have an ability where, if they've put the 15% on or whatever they're doing with you, that you can buy them out of, and pay off that co-investing, obviously, with an uptick. So what those parameters are, I don't know. I haven't gone to the website yet to look it up. But again, I just thought it was interesting to see that with unaffordability, we're going to see innovation, and we're going to see people try to figure this stuff out of how we can make money and help people at the same time. Is it naked self-interest? Well, sure. Every business, is in it to make profitability, but it's interesting how it's going to work in the housing market. I do recall, a number of videos ago, we talked about a company who was allowing people to have to do a credit, like a rent credit. So in other words, if you have income that's maybe not stable or not timely, that they could actually dip into a credit facility where they could pay your rent for you, then you pay them back as well too. So you're not defaulting on your rent and things like that. So again, just more of these innovation concepts are going to come forward. Are they really good for people? I just think this just gives somebody one more opportunity to overbuy and put themselves in a maybe higher property value strata, maybe have more, like, it's not a second mortgage. They don't have to pay a note on that $15,000 on a monthly basis, but it's still there. So, and they say, we're gonna win with the homeowner, we're gonna lose with the homeowner. That was their perspective. So, for example, if what happens, they buy a home for $1 million, they put that 20% down, and they sell a couple of years, and the home prices have dropped. It's $900,000. Well, I guess the concept is, the pro rata, uptick in profitability is also going to be the same for loss. So if you sell the loss, you got to pay back a certain percentage of the agreed upon, uptick, was also now called the downtick as well too. So that's your situation. So again, interesting to see what goes on in the marketplace and how how people figure out any way they can to get more people into housing. So interesting to kind of go on that concept. What I've seen the past few days, a lot of discussion, a lot of interesting notes going back to the REITs, institutional investors, large investor position. And clearly with lower inventory and high prices, a lot of investors are not going to jump into the marketplace and purchase properties at the peak because it doesn't make sense for them. It doesn't make sense for anybody, purely for an investment. If you're looking to buy at the peak, you want to buy on the way down or on the way up or at the trough, or a discount, some reason why you're buying is cheaper than most, and you're going to strike a deal for that. So build to rent is exploding now, and I guess this is probably interesting because I can see a lot of the home builders who are struggling kind of going, what, we could do this. We can work with these hedge funds and these REITs who are looking to essentially build communities that are all rental homes. So just to put things in perspective, the build to rent volume was 37,000 homes in 2017, was 43,000 homes in 2018, and the estimate will be over 100,000 homes for 2019. So we're talking more than double from last year. The concept really is an investor who would otherwise be buying homes either at auctions or in non-performing loan asset transfers from lenders, whatever. Instead of actually buying older homes, putting money into them, fix them, and having deferred maintenance issues and whatever, they're going to the builders now and saying, we'll pick up these 20 homes in your development, or we'll do this and we'll pick up all these homes, because they're buying a brand new home which has builder warranty, new appliances, new items go into the homes, you've got manufacturer's warranty. So if you think about it from a landlord perspective, you're not going to have to do a significant amount of maintenance for a number of years. Yeah, you're going to have the odd little fix here and there, of course, but in the end, new AC units. I live in Florida. Our AC is cranking like you wouldn't believe now, and you got to maintain it. If you don't maintain it, it's going to crap out. It's going to cost you thousands and thousands of dollars to replace. Well, brand new, you're rolling in all these new appliances, products, infrastructure, etc., into the home, and you're good for at least 10 years without a repair. And look at now, like roofing, shingles, there's 35, 40, 50-year shingles on roofs now. Come on, there's, wiring's better, windows are better, everything is better these days, and codes are of course have increased over the years as well too, from the 70s and 80s. So the point is, you're able to get a product that you can rent out, and essentially, you're not going to have to spend additional money repairing or improving that product. So just to show you why this is so interesting, they look at this retail growth, 4.5% year over year for renting single family homes, whereas multifamily growth is only 3%. So single family home growth has proven to be a better investment in the end. Also found that single family investment is less volatile with respect to turnover, and less volatile on management than multifamily as well too. So I guess in the end, the analysts look at this and saying, you got a single family home, it's brand new, you're probably going to gain more on it. There's probably less management, less volatility. The asset's probably a stronger class than multi, and off you go. So that's, and I look at it going, people are probably gonna be less hard on their homes. Multi, you've got a greater mix of people coming in to the apartment complexes, studio, 1 bedroom, 2, 3 bedroom, whatever that is. So there's lots of turnover, lots of flux, lots of different people. But I guess from what they're saying is that, the rental growth is rents grew 4.5% year over year as opposed to 3%. That's the difference. So, single family rentals are a strong asset class. We've just seen that, a few articles, that's why it all ties in, that, more people are thinking, I'm not going to buy a house, I won't be able to buy a house, I'm going to have to rent. And we know that rents are getting squeezed and pushed upwards. So, this seems to make sense. So that's why the big players are going, let's jump in right now, get these homes, contract these homes from these builders, and we can go from there. Now, the what's on the back end of this, which people don't discuss, that's great, but are these going to be rental communities? And if I'm a homeowner in a community and there's, say, an HOA, typically HOAs have, maybe with respect to builders, there's HOA, there's limits on renting availability in a home. Like if you're in a community that has an HOA, there's going to be some restriction and bylaw that says you can't do weekly rents, you can't do short-term rents, you can do 6 months or year-long leases, whatever. So just realize that some of this is going to affect some of those communities, or we're going to see the fact that developers and builders are be working on purely rental communities now to avoid that, because again, part of the issue is that if you're mixing a high rental market concentration with homeowners, then they go, well, we're going to see devaluation in our property values because of the transient nature and things like that. But again, I'm sure like anything, they're figuring this stuff out, and we're probably going to see purely rental communities that look just like any other subdivision that are going on out there right now. So very interesting, to say the least. Which takes us back. Which takes us back to my last video on sort of this iBuyer technology, and the reason why I wanted to comment on this last is because I think it's really important. Kind of sums up what I was talking about in a very succinct way. So this, of course, was in, I'm thinking it's Bloomberg right here, and it's talking about how, a decade after the housing crash, it's possible to buy a house with the click of a mouse, which is great. So it could lead to a far more efficient and affordable housing market, or another devastating bubble. And I guess that's their point here. So when we look at this, I'm not going to read you the whole article, but the point they're trying to make is that iBuyers are moving faster these days. For example, in Phoenix, where a lot of them are actually doing their trials, or that was their ground zero. So iBuyers in Phoenix make up approximately 5% of the homes that were sold through instant buying, which is not a bad number as they grow. But this is the clicker here, guys, or the kicker. It says, but the real potential of iBuying is during the next real estate downturn. As the real estate market slows, the opportunity to sell instantly will become more attractive, and more properties could end up in the hands of big investors. And that's exactly kind of what my point was last video, is the fact that when I look at the general comments, and there's nothing wrong with these comments, but I just think that this is now a new twist that we have to look at and think about. Everybody wants to buy at the best price possible. That's just human nature. And of course, we all want to do that, and I want you to do that as well too. I'd want to buy, I want to flip, I want to do things at the best price possible. Either we have the most equity that we're building, or we're making the most income, or most long-term wealth. We all want the best possible price. The point I'm trying to make, though, is that these iBuyers will start to see the trends and know things before the average person does, and they will already have started to react to it, so they're getting those deals as they flow down. So if I'm sitting here and go, well, I'm going to wait 2 years until it's rock bottom and I'll make my purchase, well, maybe you won't have the same selection you thought you would, because this is different than the last housing bubble. Okay, there's a ton of similarities with the last housing bubble that sort of indicate that we're there right now. But there's these new twists. We're 10 years plus from the last housing bubble with all this new technology and new players. So this is how it's going to affect us. So again, they will know, and you see your house value dropping. For you to put it on the market with the real estate agent, with your neighbor, and now we're dropping price every 2 weeks, and we're doing the whole same thing. Oh, I need to sell it, and I've got open houses and showings, and I got a contract, and then now I have to do inspections, and now as the market's dropping, my buyer has a loan, and they have to get an appraiser to come out and do an appraisal for the loan, and if it's a market that's starting to depreciate, is that appraiser going to come in and go, I don't see the appraisal going up, I see it going down in the future, and now your purchase price is out of whack because the property's not going to appraise, or it's not going to be there for the loan to value. Like, there's all these things that could go wrong if you envision that. So I just think that this is really a poignant article, because it sums up what I was trying to say if I didn't say it clearly last time through. But the point is that People, large investors, are thinking about that now. They see the marketplace. They know it's going to happen. They're waiting for it to happen. We'd be foolish to think that they're not already figuring this stuff out. They will try to scoop us, and that, this article just sort of, I guess you could say, runs that model is what it does. And in the end, for me, it boils down to this. It says, in either case, emerging technology has the potential to radically transform the economics of housing. It could lead to an expansion of supply, making housing more affordable, or it could lead to the financialization of housing, the end of the owner-occupied era, and a new source of economic instability. Policymakers will have to keep an eye out for which scenario is emerging and what, if anything, they can do about it, because this will change the landscape of our real estate market. This will force more people into renting. So what's happening here is, as I said, single-family residence is now becoming a financialized commodity, and people are looking at this as, purchase price on multiple of rent. That's how these models are going to work. So the more these guys buy, the faster they buy, the more aware they are of the market changes. They're going to acquire more properties, which will leave less and less properties available for the average buyer. I'm not even talking about the average investor buyer. I'm talking about the average homeowner person who just wants to live in a house and engage their life. I mean, that's simple as that. So this is what concerns me in the future, and something that we really have to look at. Again, it's a carry forward from last video, but sometimes I just feel that if I talk about it and people kind of sort of go, yeah, I get you, but I don't really like what you're saying. Well, now it's when you hear it or see it in print, it kind of justifies the position, and it just, for me, it's one more thing I need to look forward to, or to look forward at, so I can adjust my business and my housing analysis and how I want to enter into the marketplace, or what I'm going to do with investments and things like that. So again, there's still segments that they're not hitting as far as because they have to have seller participation, and in certain market segments sellers don't participate until it's far too late. So that's maybe the next video. We'll go into that a little deeper of how we can get our hands on, again, some of that inventory, which you kind of know what it is, but I think we have to make a stronger effort at going after it. So again, having said that, again, thank you for the time today. Thanks for the views, the comments, the likes. I appreciate that. Please share the video with your friends and followers. If you would, that would help me out a lot. If you're not already a subscriber, please subscribe. Help our channel grow. I'd really appreciate that. And again, I've spoken to a lot of people, engaging a lot of people right now. I do believe that the real estate market is changing. I think that we need to focus a lot more on affordable housing, and we certainly need to focus on what's coming in the future and how we can position ourselves to combat that, or to work within and around that to our benefit as well too, because any major market disruption or shift, there's always ways to mitigate the damage and work around it, or play into its hand, making money and taking advantage at the same time. So I'm not saying this is a doom and gloom scenario. I'm just saying we need to expect some changes. Let's figure out a way to work around them in the future, so we can all either make money, get properties, do what we need to do, so we can be happy. So again, please reach out to me if you'd like some more information on buying and selling, real estate investments, short sales, foreclosures, pre-foreclosures, things like that. I know I'm talking to a lot of people right now. This is where the future's going. This is the market that's untapped. And again, look forward to speaking with you later on the week. Thank you.